Hello and welcome to the Saturday Summary for September 13th, 2014, your weekly summary of market and economic news for annuity and life insurance professionals. I'm Jonathan Nidling of Brokers Alliance, here for the biz. Well, this was the worst week for the broad indexes in 6 weeks as all broad indices posted losses for the week. The S&P 500 declined by 1.1%, the Dow and Russell 2000 indices declined by about 0.8% each, and the NASDAQ Composite Index fared a little better but still posted a loss of 0.33% for the week. Now this brings the Russell 2000 index back into negative territory year to date for 2014. The Dow Jones Industrial Average is now at a 2.48% year to date result. Well, what about overseas? Well, the Euro Stoxx 50 index fell by 1.23% this week, while the Hang Seng index in Hong Kong posted a weekly loss of 2.5%. Now of note, given that it is mid-September, it's notable that none of the broad indices we track is at a year-to-date gain of 10%, although the NASDAQ Composite is close. Well, once again, most of the action was on Friday this week, accounting for the majority of the declines, despite the now nearly predictable selling of VIX futures in the last hour to try and spur a positive close. We see that at this chart. Well, this week it didn't work, and as you may recall, we've talked about this before. Many say the Fed is behind this Friday VIX selling, trying to keep the market up going into the weekend. Nobody really knows. Now, the Friday sell-off in stocks was ostensibly due to fears that at next week's meeting of the Federal Open Market Committee that the Fed will signal a sooner increase in interest rates than the markets have generally been expecting. Bank of America released a warning to that effect on Friday morning, and Goldman Sachs echoed that sentiment later in the day. Now, the Friday selling may have also been influenced by the turmoil that may result if Scotland votes for independence from Great Britain next week and the new round of U.S. and Eurozone economic sanctions against Russia that went into effect on Friday. Note also that the CNN Money Fear and Greed Index ended the week at fear. Again, we see that here. Now, many market watchers, including myself, noticed this week that not only did stocks decline, but the outflow from bonds continued as well, especially corporate junk bonds, but also from U.S. Treasuries. Now, the yield on the U.S. 10-year Treasury note closed the week at 2.61%. This is a welcome increase in yield of over 6% for this week alone. Now, gold continued to fall as well. It declined 2.7% just in this week. So going into the weekend, many pundits noted what seemed like a change of sentiment, although without any direct catalyst, but perhaps a combination of catalysts, not the least of which was the confirmation that corporate stock buybacks are decreasing very rapidly. You can see an article on page 5 about that. Many market pundits on Friday described the markets as exhausted. But markets don't get exhausted, nor do they die of old age. They need a catalyst to fall significantly, which of course has not yet happened. But it seems that there are so many potential catalysts out there, including the upcoming end of the Fed's QE stimulus in October, the Russian-Ukrainian crisis, the ISIS crisis, and little real improvement in U.S. economy with deteriorating conditions in the Eurozone, that we may be seeing the start of a slow sell-off for all types of assets. Stocks down, bonds down, gold down, worries about interest rate hike sooner than expected, thus our headline, the start of a dash to cash? Well, this week we're going to focus upon an article at page 6 of the summary titled, Top 10 Reasons You Should Never Borrow from Your 401k Plan. It's published this week at MarketWatch. Now, although it is not the intent of this excellent article, it struck me as one of the most powerful arguments for using permanent life insurance as a supplement to, or as an alternative to, a 401k plan as a retirement savings vehicle. Now, we can contrast the author's top 10 reasons to a permanent life insurance policy, and we see that at the chart here. Reason number 1, borrowing defeats the purpose of an account. Well, with a permanent life policy, borrowing is a benefit of the account and the policy loans. Reason number 2, the magic of compounding will be lost. Well, with permanent life, compounding continues because your cash value is not reduced by the amount of the policy loan. Author's reason number 3, you're likely to sell low and buy high. Well, very similar to reason number 2, with a life insurance policy, this is not applicable because the cash value is not reduced when you take the loan. Author's reason number 4, you will be charged interest and fees. Well, with the permanent life policy, you will be charged interest, but you'll also be credited interest on the loan amount. Author's reason number 5, contributions could be suspended. Well, this is because some 401k plans will not allow ongoing contributions if there's an outstanding loan amount. Now, with a permanent life insurance policy, you control the contributions, not your employer's plan's rules. Author's reason number 6, your take-home pay may be reduced. Well, this is because many plans require payment of a 401k loan via payroll deductions. Now, we contrast that with our permanent life policy, in which a policy loan does not require repayment via some kind of paycheck deduction, as is the case with some 401ks. Author's reason number 7. Failure to repay by the deadline will trigger a tax risk. Why is this? Because a loan from a 401k has to be repaid in 5 years, or the tax penalty will kick in. Now, of course, with a permanent life policy, there is no repayment deadline to a policy loan. Author's reason number 8. If you quit or lose your job, the loan will become due within 90 days. Of course, this is the tax code. Now, with a life insurance policy, your cash value and policy loans are not connected to your employment at all. You're in control of this. Author's reason number 9, you'll incur double taxation. Now, what he means by this is you're paying back a 401k loan with after-tax dollars that ultimately will be taxed later when withdrawn. Now, with a permanent life insurance policy, of course, your premium contributions are already made with after-tax dollars. And finally, author's reason number 10, you'll still be in debt. Well, with a permanent life insurance policy, you'll still owe the policy loan amount, but that debt is offset by the death benefit and the growing cash value. In a nutshell, the article is pointing out the inflexibility of a 401k plan for those unforeseen events in life that can occur along the way to retirement and cause you to need to get some cash. Now, of course, we can add to the conversation the ultimate difference at retirement between a 401k and a permanent life policy: taxable versus tax-free income streams. Well, at Brokers Alliance, we're experts at the proper design and use of permanent life insurance as a retirement savings vehicle, and our IFL Income for Life program is the nation's leading set of planning tools to help your prospects and clients understand the benefits of permanent life insurance policy. Now, we'll end today with our quote of the week, this week from John Husband of Husband Funds, who in his weekly commentary about the markets and the coming correction said, and I quote, "The best that investors can hope for is that someone else will be found to hold the bag, but that requires success at what I'll call the exit rule for bubbles. You only get out if you panic before everyone else does. Look at it as a game of musical chairs with a progressively contracting number of greater fools." End quote. Well, that's your Saturday summary for Saturday, September 13th of 2014. Have a great weekend. We'll see you next Saturday.